Debt, a concept that many of us has been misunderstood. For many, just hearing the term debt strikes fear. But what if I told you that, contrary to popular belief, not all debt is bad? In fact, rich people make most of their money through debt. Yes, that's right. Debt may be utilized to bring you money if used effectively with a clear strategy and aim. Rich people leverage debt to increase the returns on their money by taking out low-interest loans and spreading their ownership over assets. Their assets are producing returns, while their borrowed money is earning returns and increasing their net worth. In today's video, we are going to talk about 5 ways rich people make money from debt. So make sure to give the video a thumbs up and subscribe to the channel if you haven't. Getting back to the video, let's start with the number 5 way through which the rich make money with debt. Number 5. Margin investing. Rich people can purchase more stock than they can afford by using margins to invest in stocks at higher prices. They might, for instance, leverage their investment and create a margin account if they have $10,000 in their standard brokerage account. In this way, they only need to put up a maximum of 50% of the total cost of the stock they want to buy in order to open a margin account. They would have $10,000 in cash, and their broker would lend them an extra $10,000 so that they would have $20,000 in total. Therefore, in this sense, their investment of $10,000 provides them with a purchasing power of $20,000. After that, they invested in stock at a value of $20,000 and make a profit. Then, once the value of the stock is increased, they will pay off the debt while keeping the profit for themselves. However, you must exercise extreme caution since this approach is linked with a high level of risk. The drawback is that a margin call may be placed on your account by your brokerage firm if the value of the equity in your account drops below a specific threshold. If you don't have enough cash to pay your broker's margin call, your broker may sell off all of your stock investments, causing you to lose a lot of money. Number 4. Real estate. Real estate is another popular way through which the wealthy may amass wealth via debt. They are able to double their initial investment by multiples of 20 with just a 5% down payment, or by multiples of 1,000 with monthly payments when they buy real estate. An investor in real estate may purchase a home worth $200,000 with a monthly payment of $2,000 by making a down payment of only $10,000. Investors in real estate are eligible for returns not only on the money they put into the venture, but also on the total amount of the loan. If the piece of real estate appreciates in value by 20%, from $200,000 to $240,000, then the initial down payment of $10,000 will result in a return of 300% when combined with the investment return of $40,000. Debt may also be utilized to purchase monthly rental properties or residences to be used as Airbnbs in order to generate cash-flowing assets for monthly income via leverage. The cash flow returns are calculated based on the total debt, not the amount of money that was put into the property, which results in far higher returns. Number 3. Short selling. Short selling is the opposite of purchasing and then selling stocks. Selling something that you don't really own is referred to as selling short. When you sell a stock short, you take out a loan from your broker to purchase the stock, and then you sell it to another buyer. You are then responsible for paying the broker for the shares. You will be given cash from the sale, but you will have to use that cash toward the purchase of shares at a later date in order to repay your broker for the loan of shares. On a short side trade, you are long cash and short shares. You have incurred a financial obligation since you paid for shares using the credit that was made available in your margin account. When you make a purchase to cover a short position, the price at which you make that purchase will be the debit purchase price at which you will buy back the shares in the open market that you were short. After this, your broker will be able to return the shares to the account from which they were borrowed. Today, everything is done digitally, which means that it is also computerized and automated. When someone engages in short selling, they sell an asset first and then purchase it back at a later time. This inverts the normal order of trade. A profit may be made via debt if an asset is sold short for a greater price than it is purchased later on for at that time. During the time that you are shorting a stock, you will also be required to pay margin interest on the amount of the position that is held. you're going to be responsible for paying any dividends that are accrued on the stock during the time period in which you are short. This is how the wealthy can profit from the stock market's ups and downs. Number 2. Using commercial loans for a startup business. The next way through which the rich amass wealth via debt is through using commercial loans for startup businesses. There are commercial loans available that could enable you to start or keep growing a business without using too much of your current cash. If you already have a business or are in the process of starting one and have a well-developed business strategy that is ready to implement, you may be eligible for one of these loans. Most of the time, if you want to open a commercial loan, you will need to connect with a local bank lender or an expert who can help you apply for a loan from the Small Business Administration. Although the conditions of this kind of debt are specific to your company, your financial status, and your plans, it may be advantageous for you to take on this form of debt, since it enables you to make greater initial investments in business equipment and inventory. Furthermore, it will offer initial workers greater compensation, which will help you recruit applicants of the highest quality. In addition to this, it will be able to deduct company expenditures, which will result in tax advantages. And last, employing money that you have borrowed to chase profits for your company might help you keep more of your own money for use in other areas of your life. Number 1. Using debt for living expenses. The rich often cover their day-to-day expenditures with debt in order to avoid paying income tax and to conceal taxable events such as the sale of assets for capital gains. For instance, they may take a margin loan on their portfolio holdings with their broker without being required to sell any of their stocks at the moment. They could then pay the loan back later by selling stocks that are down, which would result in no taxable capital gains. Individuals with a high net worth also have the option of subsisting off of credit lines that are secured by their assets and only paying back their loans from sources that have efficient taxation arrangements. Some examples of this are the sale of a personal home, which is not taxable in most states, the sale of losing investments, and dividends, which have a lower tax rate than income, margin loans, and capital gains on stocks, which have a lower tax rate than a high-income tax bracket. That's all for today's video, guys. What do you think of today's video? Tell us your views in the comment section. Thank you very much for taking the time to watch this video. See you in the next video. Until then, best wishes.